YouTubers, Mike Martins here, Mike Martins channel. Thanks for joining me in my housing segment. Small rate hike? Here's how a $1 million mortgage can now cost Canadians over $900 large. Canadian real estate prices aren't just getting more expensive, the cost of carrying a mortgage is as well. It's often said that the power of compound interest is the most powerful force in the universe. Mostly from people in finance looking to explain how interest accumulates over time. That's great for people lending the money, but not so much for those that are borrowing it. As interest rates rise, so do mortgage rates. Despite the seemingly small increase in mortgage rates, the hikes will add up to be quite a bit. To explain this, we ran some numbers to help break down the financial costs of loans. So guys, remember when I was talking to you guys how back in the day, whatever you borrowed from the bank, let's say at 3, 4, 5%, the bank would in return give you that much in your savings? Yeah. A lot of people are listening to me talking about this, but they probably won't believe the banks used to give you 4.5 up to 5% on your savings. If you had any amount actually with ING Direct and other banks, and now, because interest rates went to nothing, people with savings, basically, they're losing value through inflation. But anyways, that's another discussion for another time. About the calculations, in order to run these numbers, we had to make some assumptions about how the rate and the term of the length for the rate will be used for Bank of Canada. The average 5-year fixed mortgage rate. Yes, some people can go cheaper mortgage rate, and for them, awesome job. You are much more likely to secure a lower rate for a mortgage broker. However, the majority of people use one of the big banks and pay the premium that works out to tens of thousands more for the privilege. This makes the average rates a little higher than you should actually pay. We're going to use the average, but hopefully you're smart enough to shop around for a lower rate. From term length, we used a 30-year amortization and assume the mortgage rate will be the same for the whole length. And so they keep it simple. So they're going to have the amortization and a term. So it's the same rate right through, so they can easily calculate it, because usually you renegotiate after your term's over. And then, yeah. So let's look at this. In Canada, the length of a fixed mortgage rate is typically 5 years. And at the end of the 5 years, you get a private rate roulette. So if it goes up, it goes up. If it goes down, it goes down. So you kind of, it's better than variable rate, okay? And we'll end up paying whatever the rate is to renewal. There's a chance that rates might be lower at renewal, but there's the above historic loss. Odds are they will be higher in the future. So don't count on interest in these calculations are likely underestimated. Got it? Onward. So we are on the rate roller coaster. Currently, rates are doing a minor climb, but we're just off the all-time lows. Just the average 5-year rate is 4.99, which is 7.54% increase from June 2017. June 2017, when an all-time low. Likelihood to roll back to that number probably, however, this time 5 years ago, the rate was 5.24. Like I keep telling you guys every time, a normal housing rate in a normal universe, in a normal dimension, it's about 5%. 5 to 5.5 is very normal, okay? So if you borrow $100,000, you're paying $5,500 back a year in finance charges, roughly. I'm just saying roughly, okay? If you borrow $1 million, you're paying $55,000 a year roughly in finance charges, because the money had value at the time, right? These numbers don't sound all that different, but you'll see the big impact this will make on the bottom line of your mortgage. So this is the whole reason why I made this video, is this right here. This is your average 5-rate mortgage rate in Canada. Now, I want to know in the comment section who remembers this. When mortgage rates went up to 21%. I don't know who remembers that. But rates went so high in 1981. Mind you, a house was 60 grand. But you could pay that off still faster than today's ways of the way things are going right now. Mind you, you could still pay it, but you could still pay it off because you make extra payments and pay it down as fast as possible. Mortgages were a lot more flexible back in the day to pay them off faster. Now, you could pay off your house in like 5-6 years, but look how high rates were back in the day. Wow. Mind you, again, housing was a lot cheaper. So I wouldn't mind paying this, honestly, on $100,000 house, a 4-bedroom, 3-bedroom, 4-bedroom, 3-car garage. I wouldn't mind paying that on $100,000. It's because it's worth it. You're getting value for your money. But look at, and then there was the huge crash. And boom, everything crashed right here in '83 when everybody lost all their rentals and everything. It was really bad. And then it went back up, then it went down, then it went back up, then it went down, then it went back up, then it went down, and went down, and went down to historic lows. And things are going to start creeping up soon. The cost of carrying $1 million mortgage. Some people say that the cost of a home doesn't matter to people. The only cost of carrying that home. For example, a $1 million mortgage at 4.9%, you're looking at a $5,362 payment per month. Just for interest principal. So remember what I said? $1 million is going to cost you roughly like $45,000 to $50,000. That's about what you're looking at right there. Principal. That's about $200 more a month from 4.11% in June 2017. If rates rise where they were 5 years ago, you would be paying an extra $153 a month, which is a 2.85% increase from today. That sounds like just a few bucks, but it adds up to a serious amount of cash. So let's backtrack one whole second here. Who the heck is going to pay that in the first place? Might as well just rent for $1,500. Why? Anyways, estimated mortgage payment on $1 million in Canada. There it is right there. Wow. Huge. And there it is per month right there. Look at it back here, guys. Imagine September 1981, you borrowed $1 million, let's say, to invest in... Well, if you invested in IBM at the time, you'd be a quadrillionaire, but a lot of people didn't. So, $18,000 a month. Imagine, people. Wow. If you borrowed $1 million. But, mind you, again, houses were like 40 grand, 30 grand, 70 grand buys you a big house. So, you got to remember that, okay, guys? Calculate using the average over 5-year rate, assuming that a 30-year amortization, the same interest throughout amortization, only includes mortgage and principal payments, so you have to add taxes, etc. yourself to source the Bank of Canada Better Dwelling. So like I said, guys, I really recommend you guys to calculate your TDS, especially if your rates are going to be changing. I am not an advisor. I don't know nothing. I don't know anything about the subject. All I'm just talking. So anyways, so let's keep going here. Total cost, mortgage, principal, and interest. Borrowing $1 million for your mortgage today is 4.99% mortgage rate. You'll have to pay back a total of $1,930,000 in interest and principal in 30 years. That's more. That's right. It'll cost you $930 large in interest on that million. If rates were at an all-time high for the months, we'll have to pay $854,135 in interest. A tiny bump in mortgage costs of $76,000 if mortgage rate jumps in the year. If rates climb, they were 5 years ago, you'll have to pay back almost $1 million on $1 million you borrowed. Anyways, guys, my son's calling me to come upstairs and eat, and it's time to go eat. Let me know what you guys think. I really want to hear your feedback on this one. This is a really good article. Please share it and get it out there so people know what they're doing. And like I said, guys, before, don't take my advice on anything because I don't know anything. I can't even read. Thanks for watching.